Hey everyone, welcome to the channel. If you've been keeping an eye on the financial markets, you've probably noticed that certain bank stocks have been on a serious roll. In particular, I want to chat about one big player that's been turning heads lately, Goldman Sachs. There's a lot to dig into, from how its revenue is split up to what folks see happening with its earnings in 2025. I'm going to share some key insights on what might keep this stock climbing, and also point out a few reasons it could stumble if things don't go according to plan. By the end of this video, I hope you'll get a better feel of whether it deserves a spot in your portfolio or if you should think twice before jumping in. So let's just dive in. Goldman Sachs has had a pretty wild run recently. Over the past year, its stock shot up almost 46% and is hanging out less than 10% below its 52-week high. It's not often you see a big investment bank climb that much in such a short period, especially with everything that's going on in the interest rate landscape. Some say it's set to break into new 52-week highs again in 2025, as long as market conditions don't go haywire. Now, without guaranteeing anything, when you look at this firm's track record, it's hard to ignore how consistently it's performed compared to a lot of other financial institutions. What exactly has driven that performance? Well, Goldman is divided into a few major pieces, but most of its revenue, at least recently, is dominated by two heavyweight segments: global banking, sometimes called the investment banking side, and asset and wealth management. They do have a smaller platform solutions business, but that slice isn't significant. The global banking segment covers all the classic stuff you'd expect from an investment bank. I'm talking about underwriting deals for companies that want to raise money in the equity or debt markets. Those investment banking fees have been a bright spot so far, and the equities portion also had some good year-to-date growth. But like anything else, the higher interest rate environment we're staring at can throw a wrench into the works. If rates stay high or climb even more next year, it might slow down the appetite for new bonds or fresh equity deals. Everyone knows that when money's more expensive to borrow, folks get picky about what deals to chase for clients and collecting fees. That means the bigger clients' assets grow, the more money Goldman rakes in, because those fees are often based on percentages. So if the market's on a tear and people keep pumping money into Goldman managed funds, that spells higher revenue for the firm. One good thing about their asset management business is that it's been steadily growing its assets under management for 5 years running. We've seen a few bumpy markets, but somehow they keep the trend moving upwards, which is always nice to see when you're evaluating the long-term stability of a bank's business model. Now, speaking of stability, the bank's got a solid track record of beating earnings estimate. Over the last few quarters, they've not only met but exceeded the Wall Street's expectations for earnings per share. In fact, for the upcoming quarter, some analysts have bumped their EPS estimates up from $7.93 to about $8.35. That's a decent jump, and optimism like this tends to spill over into the stock price. Looking beyond this year, some folks project about 18% EPS growth in 2025 and another 13% in 2026. That kind of growth, if it actually happened, is a huge deal for a major financial firm. That's already clocking in billions of revenue each quarter. Now, valuation-wise, Goldman's also looking pretty solid. If you compare its price-to-earnings ratios from 2025 and 2026 against a handful of its peers, you'll see Goldman trading at a low multiple. Same story if you check out the price-to-book ratio. Goldman comes in cheaper, and it's been increasing book value in a steady, almost mechanical fashion for quite a while now. Most banks do aim to grow their book value year after year, but Goldman's track record is notably consistent. That can be a good indicator that management's controlling risk and generating returns across different market cycles. However, we can't just brush off the risks like usual. High interest rates could really rain on Goldman's parade. If they stay elevated longer than anyone expects, for one, expensive borrowing costs might shrink the pipeline for companies wanting to launch IPOs or issue new bonds. And historically, anytime rates shoot up, big banks can see a dip in the willingness of clients to get out there and make deals. During 2022 and 2023, that's sort of what happened. You had a lot of market uncertainty, and it ate into both revenues and net earnings. So the rate environment in 2025 really does matter. There's also a side note about income investors. If you like dividends or you're hunting for yield, Goldman's got something interesting. Those Series A preferred shares that offer a forward yield of over 6%, that's a pretty juicy payout. The catch is that these shares carry a floating rate, which might not stay as appealing if interest rates head south. Nobody knows exactly where the Feds will take rates in the next couple of years, so there's a bit of a gamble there for folks who just want a stable income. Anyway, stepping back for a broader perspective, Goldman's not just about investment banking anymore or wealth management. Part of its success comes from being this one-stop financial powerhouse. It's known for leading big M&A deals, guiding some monster IPOs, and giving wealthy clients specialized access to alternative investments. They've also got a pretty huge presence in private credit, which is basically lending money outside the traditional public bond markets. Some people think private credit is a new frontier for massive growth, with estimates saying it could explode into a multi-trillion-dollar space in the US alone. Now let's talk about more recent numbers. In Q3 of last year, the company reported revenue north of $12 billion and net income close to $3 billion. They also set a record for assets under supervision, hitting the $3 trillion mark. That's a mind-blowing figure when you compare it to smaller banks or even some of the big asset managers that don't even come close. In the asset and wealth management division, the growth rate's been around 11% a year for assets under management, with revenue growing a bit faster at 12%. That basically says that not only is Goldman bringing in more client money, but it's also squeezing out more fees in a healthy way. And guess what? They rank as the fifth largest alternative asset manager globally, handling stuff like private equity, hedge funds, infrastructure, and various credit products. The scope of their operation is pretty massive. Another reason people keep an eye on Goldman is its strategic moves. They've been pushing something called One Goldman Sachs, which basically tries to bundle all their services, investment banking, asset management, private equity, credit solutions into one platform. The idea is that if you're a client who comes in for M&A advice, they can cross-sell you wealth management or alternative investing strategies in a more streamlined way. It's a pretty smart approach, given the bigger clients love having all their financial services handled under one roof. That synergy can lead to more stable income for Goldman because they're less reliant on any single line of business. The political and economic backdrop can also be a tailwind. Changes in regulations or reduced reserve requirements might let banks, including Goldman, put more money to work in deals and share buybacks. Sometimes relaxed regulations open the door for more robust M&A activity. If that environment persists, it's possible Goldman's next few years could be incredibly profitable. Keep in mind, though, that we never really know which political or economic factors are going to shift. Something like a sudden change in the administration's stance on corporate taxes or new oversight on financial instruments could drastically alter the outlook. While we're on the topic of macro risks, it's worth noting that if interest rates get jacked up again to fight inflation, that might put the brakes on IPOs and broader deal making. We saw a slowdown in new listings and bond issuances when rates climbed before, so you always have to ask whether the same pattern might repeat. Plus, if the economy wobbles, trading revenue can be hit or miss, depending on how volatile the markets get. And let's remember that Goldman's not immune to losses if trading volumes dive. One quarter's results might look amazing because they capitalized on market swings, but if the next quarter's results might look amazing because they capitalized on market swings, but if the next quarter's calm, those revenues can dry up fast. Platform Solutions, Goldman's smaller segment. It's a bit of a wild card. It doesn't produce nearly as much revenue as the other segments, and it's faced some challenges like the transition issuance around certain credit card partnerships. But realistically, that's not the main factor driving the stock price. The big levers remain investment banking and asset management. As long as those keep humming and the bank continues expanding in areas like private credit and alternative assets, it's got enough firepower to offset any hiccups in the smaller segments. It's also notable that Goldman's trailing 12 months performance has stomped on a bunch of industry averages. That's not too surprising considering how quickly it bounced back after downturns. If you compare it to the broader financial services industry or even the S&P 500, Goldman's numbers look strong. Some might argue that the stock is already pricey because of that outperformance, and that there might not be that much room left for it to run. But the key question is whether the growth of potential M&As and IPOs and asset management justifies a higher multiple. If deal-making ramps up in 2025, it could be a game changer, driving earnings to levels that make the current valuation look cheap. There's also a flip side to it too, right? If the economy slows and corporate clients hit pause on deals, or if the interest rates rise further, Goldman might not enjoy the same growth the analysts are projecting. It all depends on how these external factors play out. The bank's diversified revenue streams give it a cushion, But no giant financial firm is immune to tough macro headwinds. We've seen in the past that banks can see big dips in revenue if trading volumes dry up or if the pipeline for new deals gets stuck. Now let's wrap this up in a way that helps you make a decision. By all measures, Goldman Sachs has a lot going for it. Robust investment banking fees, a growing asset and wealth management business that's raking in consistent fees, and a surprisingly reasonable valuation relative to its growth potential and peer group. Analysts see growing earnings at a solid clip over the next couple of years, and there's optimism about M&A volumes bouncing back. Sure, the stock has jumped a lot already, but there's a decent argument that it's still not overpriced. The big risk? Interest rates that remain stubbornly high or you jump even more, which could choke off the flow of deals and spook the markets. But if you believe those rates will stabilize or even ease a bit going into 2025, Goldman might be primed for another surge. The bottom line? I think it's a buy, especially if you're looking to add strong financial name to your portfolio. The company's proven it can handle market volatility, expand its offerings at strategic areas like private credit, and keep pulling in new assets under management. The fact that it's trading at a low P&E and a PB ratio than several of its big competitors is the cherry on top for value-oriented investors. For growth folks, the potential upswings in deal flow, and the historically reliable ability of Goldman to rake in fees from those deals. It could be a big draw for that. If you're worried about immediate rate risks, maybe scale in over time or keep an eye on any Fed announcements that might rattle the markets. Either way, Goldman Sachs looks like it has a solid case for continued growth and shareholder returns. Anyways, that's my take. I hope I helped shed some light on the stock and gave you enough to chew on before you make any moves. Let me know what you think. Do you see Goldman as a buy or are you holding off for a lower price? Drop a comment, and thanks for hanging out with me today. Good luck out there, and I'll catch you in the next one.